Okay, so this question, as you can see, is about foreign exchange. And I just want to remind you really, if it's a monetary item, then what we do is we retranslate. Because if you think about it, if you've got a foreign loan and the exchange rate moves against you, you've got more to pay. So you're going to make a loss. If it's a non-monetary loan, if you've bought something, a non-monetary asset or something, you've bought something that's not monetary, it doesn't matter if the exchange rate moves or not. You've just got a piece of asset, that's it. So no retranslation. All right, now when we do retranslate though, the difference goes to the income statement. All right, let's have a look at this question then. On the 1st of August 15, Delta purchased a machine in a country whose local currency is the groat. The agreed purchase was 600,000 groats, and there's 2.5 groats to the dollar. So basically then, 600,000 divided by 2.5, that means in dollars, this thing cost us 240,000. And the double entry would be debit machinery. So debit some plant and machinery, credit liability with 240,000. Now look, the plant and machinery is a non-monetary asset. Okay, non-monetary, whereas the liability is a liability in a foreign currency, so it's a monetary asset, and any foreign monetary assets must get retranslated. So let's retranslate that liability then. So remember the liability is for 600,000 groats. It's not payable though until September, I think I read. So yeah, oh no, October. So 31st of October. Yeah, but our year end actually, sorry, our year end is September. That's not up here. But our year end is September. So at the year end, we need to retranslate it. So 30th September, it's now 2 groats to the dollar. So 600,000 divided by 2 would actually mean my new payable is 300,000. So it's got worse for me. So what I will have to do is increase my liability by 60,000 to take it up from 240 to 300, and then debit the income statement with a loss of 60,000. Okay, the asset was modified to suit our purposes at a cost of 30,000. Well, that's okay. Any cost then would be an extra $30,000. It's not a foreign amount, it's a dollars amount. So an extra 30,000 would go to plant and machinery, credit cash, and it was brought into use in the 1st of September. When it's brought into use then, that's the date that we start to depreciate it. And its useful life was 5 years. So all I've got to do now is just depreciate the item. So 240 plus 30, 270,000 over 5 years. It came though into use on the 1st of September 2015. Our year end is the 30th of September 2015. So just 1 month's worth of depreciation. So let's have a look at that. 270,000 divided by 5 times by 1 divided by 12. Wrong way around, but anyway, 4,500 then would be the depreciation. So we would show it in our accounts at 270. So the plant and machinery would be in at 270,000 less 4,500 depreciation, 265,500, and we'd have the foreign liability in at 300,000. And on the income statement, we'd be showing depreciation of 4,500 and a loss on foreign exchange of 60,000. All right, hope it helped.